Welcome to another episode of Quest for Twice. Today is June 11th, 2024. Today I'm going to do a deep dive about the Outfront Media. Then I will cover earning updates from a few companies. Outfront Media is a display advertisement REIT, real estate investment trust. It has three segments: US billboard, US transit, and non-US. So on the bottom left, I showed its segment revenue makeups from 2019 before pandemic and 2023. Before the pandemic, its US transit revenue was almost 30% of its total revenue. Fast forward to 2023, its revenue was 19% of the full year revenue. If we look at the sales by market, as shown in the figure at the bottom right, we can see New York contributed 18% of total revenue, and New Jersey contributed another 4%. So together, New York, New Jersey was 22%. That's significantly higher than the second largest market, Los Angeles, 14%. Miami was 6%. Then there are other contributions from other major markets, with the rest of the US at 26%. Last year, Canada revenue was 5%. Now let's look at its historical revenue and margins since 2012. So we can see that in the last decade, its revenue steadily grew before pandemic, then took a huge dip during the pandemic. In 2022 and 2023, its revenue finally recovered to the pre-pandemic level in 2019. If we look carefully under the hood, we can see that its US billboard revenue actually exceeded the 2019 level in 2023. On the other hand, the US transit revenue was still significantly less than the 2019 level. Its gross margin was fairly stable in the last decade, hovering above 45%, with a slight dip during the pandemic, but still stayed above 40%. Its operating margin was about 15% outside the pandemic, then took a big dip during the pandemic with about 6% in the year 2020. There were two main reasons for the dip in 2020. The first one was during the pandemic, people traveled much less, so there was less demand for display advertisement. The second reason was because of the economic condition during the pandemic, especially related to small and medium business. So they pulled back in terms of spending money on advertisement. Now let's look at the segment results more carefully. As shown in the figure at the bottom left, I plotted the segment revenue since 2019. The lines are the operating income before depreciation and amortization, OIBDA. The way to read the OIBDA is to start from the bottom. That's the gray line, representing corporate OIBDA, which was negative. Before the pandemic in 2019, the US transit OIBDA was positive, so moved the corporate plus transit OIBDA to a positive number. But since 2020, US transit contributed very little to the corporate OIBDA. Most of the OIBDA comes from the US billboard, with a very small contribution from non-US OIBDA. Then let's look at the AFFO. That's adjusted fund from operations because this is a REIT, real estate investment trust. So AFFO is the term used by the real estate companies. So AFFO roughly equal to OIBDA minus maintenance capex, then minus the interest payment. So it's equivalent to DCF of the midstream oil and gas transporters. So as shown in the figure at the bottom right, the gray line is the OIBDA from the last several years. Then once we subtract the maintenance capex, which is a much smaller amount than the interest expense, we get the AFFO, which are the gray bars. I also plotted the dividends paid each year, so we can see the dividend payment was cut significantly during 2020 and 2021. Then it was recovered in 2022 and 2023 to the pre-pandemic level. And during every year, the dividend paid was less than the AFFO because AFFO represents the cash available to pay dividends as well as for growth capex. Here is a similar plot but on a quarterly basis. We can see very strong seasonal pattern. Usually, first quarter of each year has a low revenue as well as OIBDA. And the fourth quarter of each year has the highest revenue and profits. We can see negative AFFO during the second quarter of 2020 as well as the first quarter of 2021. That's due to the combined impact from the pandemic as well as seasonality. Dividend payments were shown as the pink bars, was recovered since first quarter 2022. Now let's look at the valuation and the risks. As a real estate company, let's look at the total debt first, which is 2.8 billion. That's roughly 6.1 times of OIBDA. As shown at the bottom of the figure, the net leverage ratio was 5.4 at the end of the first quarter 2024. The figure also shows the maturity schedule of its debt. So in this year and next, there is a very little maturity. In 2026, there is a $600 million of debt maturing. However, the company just sold the Canadian business for about $300 million. So that will be used to reduce debt and reduce the leverage ratio. At $13.9 per share, its market cap is 2.3 billion. So EV over OIBDA is about 10.5. And if we look at the cash on cash, which is a price over AFFO, we get 8.2. That's based on the assumption of OIBDA from Canadian business, which has been sold, as well as transit business will cancel out. So what are the risks? Because it's highly leveraged, so higher interest payment will be a significant risk if interest rates stay high. Another threat is there is about 7.8 million common shares can be converted from preferred stock. That's about 5% of dilution. And also working from home or autonomous driving will reduce value of displayed ads in the long term if they happen. Finally, REIT has a special tax treatment related to income tax return. So potentially an investor can have a higher income tax from the REIT dividend than from a qualified dividend. Now let's look at the earning update from Walker Dunlop. First, it's the results from its capital market segment. So we can see the yellow bars are the transaction volume in the first quarter 2024 was very low, even less than 1 year ago. As a result, its segment revenue, which is the red line, took another step down from 1 year ago. Its quarterly EBITDA was also less than 1 year ago, or at a greater loss. That's because, again, it's the revenue minus MSR impact is less than its payroll expense. So the suffering is still continuing. Just keep in mind that in 2022 and 2021, the segment EBITDA was $36 million and $85 million. So eventually, when the market turns, this segment will have a positive EBITDA again. As before, the rescuer is the SAM segment, Service and Asset Management. It has the very stable revenue, was about $140 million in the last quarter, with $120 million EBITDA. Both were fairly stable from the previous 4 quarters. The corporate annual EBITDA was a negative $110 million. And the run rate annual EBITDA of the SAM segment is $460 million. So significantly higher than the loss from its corporate segment. I continue to monitor its credit risk. So in the first quarter 2024, the maximum credit exposure was $12.1 billion, slightly up from the fourth quarter last year. The allowance for risk sharing was about the same. And defaulted loan increased from $27 million in the fourth quarter to $63 million in the most recent quarter. So the conclusion is Walker & Dunlop is subject to credit risk, which is hard to quantify with the current CRE market. However, the management is confident about its credit risk exposure and increased dividend as of at the beginning of this year. Now let's look at the Energy Transfer results. The main news is the management raised the full-year EBITDA guidance to $15.15 billion from $14.65 billion about 3 months ago. The $500 million increase actually is because of the underlying acquisition of New Star by its subsidiary of Sonaco. Sonaco is 21% owned by Energy Transfer. So this is really an artifact of accounting because Sonaco is not fully owned by Energy Transfer. As a result, I don't anticipate the full-year DCF will change, and so it stays at $8.2 billion. That's more than enough to cover the $2.9 billion of capex for this year, as well as $4.3 billion of dividend payment. The EV over EBITDA is about 7.0, and the price over DCF is about 6.4. Finally, let's look at JFrog. JFrog had a steady revenue growth sequentially from fourth quarter 2023. However, if we look at its Enterprise Plus revenue, in the first quarter it was $49.1 million compared to $47.7 million in the fourth quarter last year. So it's a significant deceleration from sequentially fourth quarter last year. So there is no sign of significantly higher utilization of a JFrog software platform. That's also shown in its trailing 12-month net dollar retention ratio of 118%. That's a 1% less than the fourth quarter last year and the third quarter of last year. So I would characterize the JFrog's first quarter results as anemic. This concludes this episode of Quest for Twice. Until next time, happy investing.